Hey, how's it going? It's time to mess with you guys today. How you doing today? Welcome to the Closing Beat. Oh man, this is a stock market update show where we talk about the stock markets, the good, the bad, and the ugly, and sometimes we got to go over the ugly. We'll cover it all for you here, of course, today. Did you have one of those days, right? Was it a little bit weird for you? Hey, we'll get to it. We're playing a game called Guess the Dow. You're welcome to guess where you think the Dow will close next week. And if you're closest without going over, just whoever's closest at this point, we'll send you $100 in a gift card. If you're one of our customers, we'll send you, of course, we can credit your account, right? If you want to have that instead, we can also send you the gift card, whatever you prefer. Anyways, we had announced the winners on Fridays. This will be an interesting one, right? Because how many people really bet on the Dow at these levels, assuming they stay down that way. Anyways, we have a class tomorrow coming up for clients. We're focused on the nest egg, I think. We're going to focus a little more on that, more on the debt side of things and your cash flows to kind of show you how the system really digs in and figures out how much you have to spend and when you do. I like the idea of focusing on our personal finances, our retirement plans and everything, while the market's a little volatile going through the end of August and into September here. And so we're going to spend some time on that one. I hope you'll join us. Email invites will go out tomorrow. Today's Wednesday. Yeah, they'll go out tomorrow. All right, let's dive in and talk about the stock markets today. They went lower. Everything was basically lower. Hope you enjoyed the show. Have a great night. No, that's not it. Oh, let's get into it here. The Dow, that's an 8. If you happen to be looking at the screen there, it says 801 points down, right? That's a pretty bad day. That doesn't normally happen. That's in the top 10 for sure over the last 10 years, or in the history, actually. So I believe it's in the top 5, actually. S&P 500 lost 85 points, and the NASDAQ lost 242, so about 3%, 2.5% across the board. When you look at that, you don't think it's such a big deal. When you look at CNBC all day and they didn't take a commercial break so that they could keep focused on this dramatic change in the markets, well, now you feel a little bit worried. It kind of bummed me out, man. I started watching Bloomberg because at least they focused on other stuff today. But anyways, that's the stock market for the day. Pretty bad there. I was getting emails all day from like other advisory companies that sort of consult advisors, and they were saying like how to handle speaking to customers in uncertain times. And I thought, isn't it too late? Like, shouldn't you be preparing customers ahead of time? The financial advisory industry and the robo-advisory industry is so responsive. They're not proactive, they're responsive to whatever happens. It just kills me, man. So I actually only had one email today from a customer that was like, hey, just new to this investing thing. Is this normal? This doesn't seem normal. And I'm like, no, it's not really normal. That's actually pretty crazy. But let's put some context around it here, try to help you out and see what's going on. Overnight, U.S. futures markets started selling off. Germany officially has their first negative GDP print. Remember, in order to have a recession, at least in terms of how the U.S. Sort of defines a recession, you need 2 quarters back-to-back of negative GDP growth. Germany had their first one. It's not looking good over there in Germany. They actually projected that there will be 0 growth across the board over the next year. So that's not a good start. Overnight, you see our futures market starting to slide off. China's economic numbers come out, manufacturing in particular. Industrial output showed a bigger drop than normal. Actually, that this whole trade war thing is really starting to hurt them. You got to worry about some of that being politically biased and everything, but the numbers are what they are. So China reported those numbers and they say, yep, this is hurting us out a little bit here going forward. So you got that. Right, we start the day here. Bonds had already inverted. The yield curve, that 2 to 10 year that we've been talking about for the last 2 days, it was 6 basis points from being inverted. Yesterday it was 2 points from being inverted. Today it briefly went inverted for a moment. What on earth does that mean, right? If you're like, I don't know, I keep seeing it. I heard Trump even talk about it today. If everybody's focused on this, what does it mean? How do I focus on this? Well, the yield curve, the 2 to 10 year yield curve briefly inverted today by a little less than 2 points if you were paying attention to it. Up at the top there, you can see it didn't finish that way. So we went inverted and then we came back out. Those were the algorithms. Those were computers going, hey, that's a buying opportunity. Just a little adjustment there. Is that too loud? Seems like that might be too loud. Let's turn down the music a little bit. All right, sorry about that. Okay, so the 2 to 10 year inversion is considered a recessionary indicator. Only because when it has happened in the past, it led to a recession. This is a bit misleading if you ask me, because you have the opportunity for really any stat. You could sort of massage stats to sound the way you like, and I'm not like a super fan of this, but anyways, it's considered a recessionary signal here. There has been an inversion every time that preceding a recession, right? Except for twice, right? So a couple times we went down there, we inverted, everything was fine. We stayed inverted for a little bit, and we didn't ultimately end in a recession. However, to be fair, the very next time that we did invert, that led to a recession. So technically, it did eventually take you down, just, not that time in particular. But the key here is that we had to stay inverted. You actually have to have the 10-year trading for a higher yield than the 2-year, and it has to stay that way, or you don't get that actual response. There are a couple times where we poked down there and then came back up and we were not inverted anymore. However, there is no time in history where once we went inverted, we didn't eventually go back and stay inverted. So just so you know, it's not like the greatest news ever there. Now, when you go back and look at the last few times that the yield curve was inverted, there's a couple reasons you could debate if this is the time that takes us down. All but the year 2000, we actually had the Fed raising rates. They were in a process of raising rates. Why? Because inflation was high. Bottom line, inflation was just high, and that they were trying to combat that. Right now, we have the exact opposite. Inflation is too low, and they're like, hey, we're trying to get inflation just a little bit higher. Inflation is not actually even to where the Fed would like it to be. So we have a different scenario here. Another reason you may not want to sort of focus on these stats too much, there's not a lot of instances. There's, 7 total that we can track? 8, I think, is the total amount there. Whenever I give you a stat, you know how I always go back and I'll say, we went back to 1929. We went back through the entire lifespan of the market. We went through hundreds, if not thousands, of different scenarios where this happened. We don't have that many to go on, so it makes the stats a little bit skewed in that sense. Anyways, what you want to know here, average time until recession, given the last times that this has happened, has been anywhere from 18 to 22 months, meaning when we go inverted on the yield curve, 18 to 22 months later, we have experienced a recession. Here's the interesting part of it, though. In every case, when we went into a recession, the actual stock market performance was better. So you got to disconnect yourself from recession and investment returns right here, because what's happened is 1 year after the inversion, the average gain in the S&P 500 is 12%. So if you use this sort of yield inversion, you see this on TV and you go, oh my gosh, I think I need to get out, and we go into a recession, you missed out. The stats are you're going to miss out on at least 12% average returns. The worst decline, by the way, when we went into a recession following this yield curve inversion is only 3%. Well, now one could argue that's 3% today, but we're not technically in a recession, right? So the worst decline was actually 3%. So when they paint this negative picture here, you go back and look at the stats and go, all right, it's not good, right? It's not a good sign that things are slowing down, but it's also not the end of the world, how it's sort of been illustrated there. Now, what in the world is a yield curve inversion? I'm going to spend a minute on this one here today, just so that those of you that have never seen this before, you know what this means. Okay, the longer that money is lent out, the more money you would expect in terms of a return. It's fair, right? The best example I have is if you get a 15-year mortgage, your rate is lower. If you get a 30-year mortgage, your rate is higher. And a lot of people say, well, that's because of risk, right? If the company's going to risk 30 years of you making mortgage payments, there's a greater chance that that you might not pay your loan, right? And so if it's 15 years, there's a smaller chance that you will pay that or go default on the loan. Well, that's part of it, but the other part of it is the company that's loaning you that money has to say, look, if I'm going to loan you this money for 30 years, I don't know if there's a better place for us to invest our money. Meaning, if I gave you a loan for 15 years for $1,000, I don't know, let's just say it's $1,000, I lent you $1,000 for 15 years. Okay, there's some risk there, so I'm going to charge you for it. If you wanted it for 30 years, there's a little more risk there, I'm going to charge you for that. But also, I have to ask the question as the lender, could I have not put my money somewhere else and seen a better return over a 30-year period? Chances are I could, and because there's that return risk, well, I'm going to have to charge you a little more for that. So the normal yield curve, I draw it upside down and backwards every time, but the less time you want to borrow money, the less someone is going to want to charge you because they're not missing out on really any other return, and they're also probably going to get paid back for you. So you look for 3 months, 2 years, 5 years, 10 years, 30 years, the interest rate gradually increases. Well, an inversion in that means the shorter time period, 3 months, 2 years, 5 years, 10 years, 30 years. Now we're going the opposite way, meaning the less time I'm going to lend you money, the more I'm going to charge you. That doesn't make much sense, right? I'm taking less risk. There's a chance that I maybe, I can't get that return somewhere else. Why would I charge you more in the short term versus the long term? And that leads to people, that all boils down to uncertainty. People are saying, I'm very unclear about what's going to happen in 3 months to 2 years. It just seems like it could be a really scary time. And because of that, I don't care, right, that I'm only loaning it for 3 months to 2 years. I need to charge you more because I don't know what's going to happen. And so that's why you have this sort of inversion. People becoming more uncertain about the short term than the long term. And really, that's what you're looking at the end of the day, to just completely simplify the whole thing there. So that's what you have there in terms of the yield curve. You're going to hear more about it now that President Trump has decided he's going to talk about it as well. Big mistake, man. I don't know. I always applaud the politicians when they do the right things. I'll give them a little grief when they do the wrong things. I don't care what side they're on. I think it's a mistake that he's jumped into some of the drama he's jumped into over the last couple days, if not weeks, really. Anyways, let's go over to the charts here and take a look. So you got the S&P 500. Yeah, it's a nasty day today, but you see a big black line that I drew on the charts there. That would be where we need to get to have a 10% drop from highs. You'd need to be all the way down to this number here, which means, well, that's a good chance that we head down to that area. Why? We haven't had any drop of 10% or more in the last year. We're supposed to have at least one. We haven't had one yet. Right? This was 7% over here. This last drop wasn't it. That didn't get to 10%, close. But we need to get down to 10% in order to fulfill the overall stats. The average decline for a 10% drop is 114 days. So far, we're ahead of schedule, right? So the bottom line is, if you're looking for an area where could the market settle in and attract more buyers, it's got to be in that 10% area there. If we look at bonds, there you go. Long-term bonds hit new highs, which means yields hits new lows. New lows for a 30-year, the 30-year yield moved to new lows. This is the pricing of it, moving to new highs. This is the direct 30-year bond. This is not an ETF or anything, taking a look over there. Because of all of this as well, you now have traders saying the Fed has no choice. The next Fed rate decision in September, they're betting that they will absolutely 100% have to cut rates again. A lot of people think rates are going down to zero, but, one step at a time, right? Let's go one step at a time. So one indicator to this is going to be, is it next week? Jackson Hole next week, right? So the Fed and the media and everybody, they meet up in Jackson Hole, Wyoming, have a beautiful sort of symposium, they call it. It's gorgeous. And anyways, they talk about a lot of things that they're going to do. There's a lot of studies that people present and everything from, there's 45 different Fed members. There's all kinds of stuff going on. Anyways, it's a chance for Mr. J. Powell to come out and say something, give us a hint about the September meeting, so people are going to be looking at that in general. Add to that today, really didn't get talked about a whole lot. Notice how I got my towel close? Keep the towel right here. Add to that crude oil inventories. Let me jump over there real quick if I can. Yeah, we can jump over there, sure. Crude oil moved back lower today. You know the resistance we've been talking about, but lost basically 4% on the day. Inventories were higher than expected again for 2 weeks in a row. It didn't get a lot of attention today, but it did take down the price of oil, and it did hurt the energy and oil areas of the market. And so that's either way, whether we were down today, we were going to get some pressure from energy as a whole. So you saw that moving lower as well. If we look into the Dow, every single Dow stock besides Coca-Cola lost over 1%. And really, it was 0.95%. Interestingly, I'm watching the series, The Food That Built America, on this whole Coca-Cola thing. Oh man, it's so cool. Side topic. Anyways, a lot of weakness there in Dow. One of the weaker names was Pfizer. If you want to look over there, it continues to sell off here. I got a lot of people asking me, is that the waterfall drop? Is that really an opportunity here in the short term? You're not quite there yet. Remember, you need the last day of the move to be the biggest if you want it perfect, and you also need the highest volume. But nonetheless, Pfizer a little bit weak there in the short term. If you look over at the NASDAQ, we'll use the NASDAQ 100 there. If you look over at the NASDAQ, also a weak day, lost 3% on the day. All the chip names were some of your weak spots there. Basically, if you look at the NASDAQ 100, there were only 5 names that did not lose 1% or more. Every other name lost 1% or more. Are you kidding me? That's a very, very aggressive decline there. Your chip names and everything were the weak spot for the day. AMD, we talked about this yesterday, had a little bit of a losing day today, 6%. That's a little bit of a losing day. We talked about that sort of bearish reversal stamp that we saw the other day on that one. Microchip also reversing all of yesterday, lost 5%. Let's move on to the S&P 500. Talking about kind of what's happened there. What has happened there? What's going on with that thing there? Got a little bit of a disconnect there. In the S&P 500, 93% of the S&P 500. You can do some math, figure that's like 470, 472, somewhere in there. Of those stocks lost 1% or more. Okay, right? Not looking good. You've got a reason to say it was a down day and there was nowhere to hide, period. Nowhere to hide. Again, the S&P 500, 10% pullback, averages one of those a year. We haven't seen it yet, and this kind of feels like this is the time. After today, it kind of feels like, all right, we're going to push that pressure down there and knock out that statistic there to lose 10% in the one time in a year. We haven't seen it yet, so we'll see what happens there. Now, ultimately, we are down 6% from the highs. We have had a 20+% gain on the year. Does it matter if we're down 6%? Would it matter if we lost another 4 and we finished down here? Probably not. Now, to those of you that would matter is those of you that just got started investing. Look at the long term here. I'm going to go back to 2018. If you started investing in 2018, just anywhere in here, and assume you're average, the best you could do was average in, and that's what happened to you. You just ended with a price that's somewhere about in the middle of all the highs and the lows here. You're not really that excited. It doesn't move the needle for you. You're like, I just spent a year and a half, and I'm sitting with a 4% gain, assuming you invested in the index fund or whatever it is, direct in the S&P, right? So it's misleading for a lot of investors, and that's why there should be panic. That's what other advisors should be focusing on, saying, look, if you invested this year, let's not paint a rosy picture and say, well, it was up 20%, now we're down 6% off the highs. That's not that big of a deal. No, take a look back at all the people that have started investing, all the great people that said, this is my time, I'm going to put my 401k up, I'm going to get my IRA, or whatever it is that you got started. You're not very excited about this. Unless you had the best of timing, this is now almost 2 years you're seeing on the charts here. So that's the picture we need to be painting, a more realistic sort of, hey, it's not great for everybody. Quit telling everybody that the markets are up and it's all exciting and, oh, it's going to be great. So I want to just point that out. All right, in the S&P 500, old Macy's, wow, 13% decline in Macy's there. They just missed on everything, right? They reported earnings, everything. Just missed on earnings, revenue, guidance, forward guidance, same store sales, comp store sales. Just horrible. Didn't go. The only thing that they beat on, by the way, was they had less returns than last quarter, right? So less people brought their stuff back. That's not great, right? So you had names that are in the same camp, like Kohl's, also with the brick and mortar stores there. Kohl's got beat to death there, 11% down on the day. Nordstrom, which has already struggled in general, hit new lows, down 10% on the day. Limited Brands, I believe, was also lower, 8% on the day. That broke to new lows as well. And so in your S&P 500, that's kind of where you landed there. Okay, I'm going to just slide over here to the different sectors of the market, and we're going to show this. Look, we got oil explorers down 5%, retail down 4%. You understand why now, right? With the Macy's and everything. Energy down 4%, metals and mining down 4%, basically. Financials lost 3.7%. This black line right here, that puts you in correction territory. That lets you know when they have officially fallen 10% from their highs. Very close, right? So you got about a 10% discount on financials. You got oil down 3.5%. Communication services, those are some of your FANG names, right? FANG was pretty nasty today. Facebook, Netflix in general, Google and the such, they just horrible. Did well, very poorly. You got Mexico down 3.5%. Regional banks down 3%. Semiconductors 3%. Basic materials 3%. Consumer discretionary down 3%. You got tech down 3%. You got industrials down 3%. You got transports down 3%. You notice there was a common theme there? 3%. Right? So it was a really tough day across the board, meaning unless you were all in on, gold, and even then you made less than 1%, tough day. Tough day in general, right? So you got retail, basically a one-day wonder. That little support they got from the Trump bump yesterday, not very good. Just not looking so good for them. Almost back down to new lows, by the way. And just, there's not really much that I can just go through and try to make a big deal out of. Just a broad-based sell-off in the markets, and you want to know how much more should we be expecting, right? Well, the only stat I have to give you today is to say we have not been down 10% or more this year. We usually see one of those a year. And selfishly, I'm kind of getting what I wanted. Remember, I've been saying all summer, I want the markets to sell off through the summertime, give us a reason to buy into the end of the year, add that to sort of the seasonal sort of moves that the market have there, and we might be getting what we want there. Hey, all right, so let's move through this. I'll take your questions. We got 29 new 52-week highs. Guess what? Guess who's in the new highs today? Extra storage space, personal storage space. You got just all hit new highs. They did finish lower on the day, so not very great there. We happen to own these in our REIT fund there, so that's why I've been cheering them on here for you. Really good there. McKesson, that's your Tyson example from yesterday. I'm not McKesson, McCormick. Let's get these confused. McCormick hit new highs there, but already extended. Remember, we pointed out Tyson yesterday. When they make these new highs, new highs, new highs, new highs, and then they blast off up there, who's buying that? Right? You're losing a little bit of steam there, so that one finished lower on the day. Not a big deal there. You had 53 new lows. That's a new 3-week record for the new lows there, a 2-week record, sorry. And a lot of them were, unfortunately, the oil oil explorer names, Apache, Cabot Oil, looking like it could be your waterfall. That's probably the best one that's getting close there. And ConocoPhillips, just all really, really weak there in the short term. All right, we talked about Macy's as the retail stock, moved to lows there, missed on earnings, missed on everything. If you like the IPOs, this is Luckin Coffee. They went public. This is their first earnings announcement there. They lost 48 cents. We were expecting them to lose 43 cents, so worse than expected. Speaking of losing more than expected, Tilray, that was lower by 15%. It's a cannabis stock here. They lost more than expected, but revenues were higher, right? They had some costs in there and stuff. Your FANG names, they were lower on the day. Facebook, 4.5%. Amazon, I think, held up a little bit better at last check there. 3.33%. It's not great, but still held up a little bit better. Netflix, 4% down on the day, and then Alphabet also lower on the day, about 3%. So FANG names taking a bit of a hit there. Tesla, also weak, 6.5%, breaking through the little range that it's been in there. There was actually a analyst report from Bernstein. Don't hold me to that, but it was from Bernstein. And basically what they were saying was, we wanted to study the turnover. You notice how it seemed like there were a lot of executives leaving, and they were like, what happened? Why doesn't anybody want to stay at Tesla? 27% turnover there, they figured out, for Tesla. Average for a growth company is 15%. And then, but to be fair, which I really liked about this report, they were very fair, and they said, tell you what, Snapchat and Lyft, they have had 24% and 23% turnover respectively, and look at their performance. So they weren't just picking on Tesla. They were saying, hey, when this happens, you typically are seeing this sort of weaker performance. That's all they were trying to really highlight there. And I thought it was nice that they did that instead of just, a lot of people have been beating up on Tesla, and we get it, right? Tough times there. Other than that, we have WeWork. If you like IPOs from companies that lose a ton of money and spend money on ridiculousness, well, then WeWork may be a company you might want to look at. They are going to be going public here. It'd be the second largest IPO of the year if they do go public. And just a fair warning there, I mean, these guys spend, like, just dig through. They put out their filing today. Just look at the stuff that they spend money on. And they don't care. Like, they're not even ashamed of it. At least when Snapchat had that $2 million New Year's Eve party, they said, you know what, that was probably a mistake. At least they owned up to it. This WeWork, oh my gosh, I think it's run by a bunch of kids who have never had to put a budget together in their whole life, and their parents were rich, because they just spent, like, designers, graffiti architects, graffiti artists and stuff. They don't just spend like $500 to have somebody come spray a wall. It's like 50 grand for them to come spray a wall. I mean, just unbelievable waste in that company. Do you know how I feel about it? Does that help you there? All right, let's take some questions, and then we'll move on for the day. Let you guys go shake it off, have a drink. WeWork, don't work. God bless them. It makes me want to go public and say, we're worth $60 billion. Go ahead. I do a daily video every day. That's worth $60 billion. I mean, it's just horrible. And they're going to get so much attention. I promise you, there'll be people asking about it. At 23, I wouldn't pay off all loans, invest some ESP, especially since the market's down. Well, I'm not going to go on that side of that. Yeah, I'm not gonna jump on that one. Would Uber drop more? Do you think they hit the lowest point there? Yeah, unfortunately. So, I mean, that's a real tough one there. You got Uber breaking the new lows. You notice how that waterfall acceleration to the downside happened. The volume picked up right when it broke those lows, because psychologically, what's going on there? You have people that said, you know what, I'm willing to hang in there as long as it doesn't break lows. It broke the all-time low, which is not saying a whole lot there, but it broke new lows. And so you have people that say, that's it. What am I supposed to do? I'm not going to take a big old loss on this. Now I have no guidance, no measurement to say that it could stop at some other level. You see how we did that with the S&P? We said, you know what, at some point it could hit the 10% down level, it could hit the 200-day moving average, and it could pause right there. It would be a reason for people to be attracted to the markets at that point. What do you have for Uber? All you can do is look at it and go, well, it's fallen a lot, but is it even worth $34? I don't know anymore, right? This was our only metric right here where we could say, as long as it doesn't go under that, I mean, I guess that's sort of in a range, maybe it'll be okay. But now that it's broken under there, notice the incredible amount of volume, that pressure to the downside. I tell you, you got to figure something out there. There's a lot of these companies that have only been a part of very strong economic growth where money was loose and anybody could just go raise money and do whatever. That's going to come back to haunt some people at some point. Bob says, do you have beach towels? No, you just have to use like 2 of these things. I make these towels for customers, right? It's just a simple thing to say, markets do recover every time. It's just a fun thing that we send out. If you're one of our customers and you haven't got one, I'm happy to send you one. But just as like a joke to say, hey, wipe the sweat off, you're going to be fine. In the long run, I think we all know this is an opportunity, maybe not just yet, but as the markets fall, it's an opportunity for those of you that like to buy the discounts. And, I like buying discounts. We got plenty of time till we need to retire or do whatever, then we're all set there. So it's just kind of a fun way to point that out there. You guys talking about your Uber. Eric says, I'm not afraid. I like buying cheaper there. You know what's funny is I have created a bunch of animals here at Jazz Wealth. I spend a lot of time teaching about market decline statistics and everything. Our dojo is just filled with videos that help out with that. I personally, you watch like Warren Buffett. Does he panic? The guy has a better track record than anybody in terms of years in the market. Does he ever panic? Has he ever panicked? No, he gets excited when the markets fall. That's what keeps him young, right? He's excited to get a discount. He's got a good deal there. So I'm sort of like trying to teach this, and I've created a bunch of animals because here when the markets fall, I get a flood of emails from customers. They're like, I'm going to make a deposit, man. Can you get me in? I'm going to put an extra 30 in, just a little bit. I want to inch in. And they get super excited to buy on the day of the drop. It's fun. I like it because, it shows that we're thinking on the right track there, but yikes. Yep. Why would short-term loans be riskier than long-term loans? Oh, so we went over that in the beginning. It's not that they're riskier, it's that there's uncertainty, right? The people that are going to be loaning out that money, they're uncertain about where they're going to put their money in the midterm. And so that becomes that. I did video on this when the 3-month went inverted to the 10-year, just to kind of explain that process there. Maybe we'll do another one here. Yeah. Any thoughts on Enphase? No, I don't follow those. I'm sorry. I don't like it. Henry bullish on Tesla. They could turn a profit, and consistently turn a profit. Maybe not too bad of a deal there, but yeah, they got tough times there. Mentioning some of your investments there. It's been pretty rough, long-term investments, so you guess you just add shares in a recession. If you have one, it's a reason to cheer on a falling market. Look, no other place on the planet do you ask for something that you're going to buy to be higher. Nobody else does that. Like, think about that for a second. You don't go to a car dealership and say, no, that sticker price ain't going to cut it. I want to buy it when it's going up in value, right? You don't go to the grocery store and say, I don't want the sale. I'll go ahead and go with the name brand ice cream sandwiches, I guess, because they're a little higher price and they keep going up in value. I want to buy those, right? But in the stock market, everybody goes, I'd like to buy here. I want it to go higher, even though I'm not going to sell it. And then I want to buy some more. And then I want it to go higher, even though I'm not going to sell it. And then I want to buy more. right? Let's think about that. Let's flip the page a little bit. Think about how you want a discount. You want things to fall. It doesn't feel good. I'm going to be honest with you. I mean, there's nothing cool about the markets falling, but when you look at that and you go, all right, this is a blip in time in my long-term sort of view here where I'm going to strike and get that opportunity. Anyways, I'll wrap it up from there. I appreciate you guys watching today. I hope you enjoyed your day. Well, remember, we'll be back tomorrow. We're going to do the class, of course. They'll do the closing beat. We also have our class for our customers we'll be doing. Look for the email to go out tomorrow. And yeah, that's all I have for you. Enjoy the rest of your day. We'll see you tomorrow.
Hey, wait! Before you go watch one of our other great videos, have you had a chance to see our new Fin Tips videos? They focus on one topic at a time, covering investing, personal finance, and anything that can quickly help you with your dough. Best of all, we'll keep it real short, because we know time is money.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.